Parets here, founder of AllStarCharts.com, and I want to give a big shout out to StockCharts TV for inviting me on so we can do this little powwow that we like to do once a month where, I like to talk about what's on my mind and, what's got us interested, what we think is moving markets, what we think is changing. A big theme we've been talking about is really the rotation. Different types of stocks have been doing well and outperforming than they were in prior cycles. Different countries. The United States is the worst performing stock market in the Western Hemisphere this year. The types of names that did well last year. Energy was the best performing sector in the S&P 500 last year. And once again, the best performing sector so far this year. That wasn't necessarily the case a couple of years back. A couple of years before that, we went through a period where a lot of the technology and growth areas were really outperforming for a long time. That ended 1 year ago this week, as a matter of fact. And that's really when the value areas really started to outperform, particularly at the small cap level. And we've definitely seen that towards the large caps for sure over the last couple of months. But that really started last February. And what's driving all of these things, I think it comes back to rates. I hate to be like Mr. Bond guy in a stock market conversation. It's like, JC, people want to talk about stocks. Why are you starting with interest rates? Because this is what's driving these markets, right? If you're curious, why is it that your favorite growth stocks have been destroyed over the last year? Interest rates ripping is certainly part of the reason, as those, as they call them, long duration trades, right? The multiples are much higher than some of these value areas. And it's funny, I'm not like a fundamental guy at all, but I have seen the numbers. These high growth stocks, just a little bit of movement in interest rates really affects their bottom line. Like I've seen like the calculator. So it is really fascinating. If you're interested, go find it. I'm sure you could find it. But that's really what's going on here. Higher interest rates definitely supports outperformance out of the more value-oriented areas of the market versus the growth. Here's a U.S. 10-year yield in U.S. 30s. Nice smiley faces. Guys, I was taught we want to be buying smiley faces, selling the frowny faces. German 10s. I don't know how many sigmas was the move last week. It was a lot of sigmas. The more sigmas, the more rare a move of that magnitude is. And German bond yields just absolutely ripping. UK, rates new highs. Look at France. Rates just continue across the board. Even the Portugals of the world are getting involved. Look at Japan. New 6-year highs in its 10-year yield. Just across the board, relentless strength in interest rates. And it's not just a U.S. thing. You're seeing it all over the world. And what's fascinating is that the sell side, consensus is really for that 2 to 2.5 area. Here we are on the U.S. 10-year yield to a little bit over 2%. So consensus on the sell side, end of year, is 2 to 2.5. Almost none of them are pointing to a 3% U.S. 10-year yield. I think we see 3%. How about that? And the fact that the sell side doesn't, I like that a lot. And it's more so the big reason you're seeing the stock market certainly confirming that, and you're seeing it in yields around the world. It's not just a U.S. thing. And then the stock market is also confirming that. There's a great ETF, not so liquid or anything like that. We use it mostly for information purposes. This is the Equities for Rising Rates ETF, EQRR, which consists of stocks that tend to do well in rising rate environments. And when you look inside, over half the index is financials and energy, right? So it looks a lot like the U.S. 10-year yield. And then when you look at financials on a relative basis, energy on a relative basis, you're seeing that outperformance, right? You're totally seeing that. So, again, I always thought we want to be buying the smiley faces, selling the frowny faces. These are areas that historically should do well if interest rates are rising. And as it turns out, interest rates have been rising, and these areas are doing well. So, I don't know, call me crazy, seems perfectly normal if you ask me. And then if you are in the camp, if you're one of these people that are like, oh, no, JC, new technology is changing the world, JC, you don't know, technology. We don't need oil anymore, electric cars, and we don't need banks, bankless nation, cryptocurrencies, whatever you're into. If you think that growth stocks that have been underperforming dramatically since last February, as you can see here, this is large cap growth relative to small cap growth. Large cap growth relative to large cap value. And then in blue, we're looking at small cap growth relative to value. So on the large cap level, you still had, they were still trying towards the end of last year, and then everything fell apart this year, right? But the small caps had it right all along. So if you believe that you're going to get that rotation into technology and into, the growth areas, and that's going to be the outperformer, this year, if you believe that, that means that you're buying these charts. These are the charts that you're buying. And in my experience, these are charts that we want to be selling, not charts that we want to be buying. So if you think the rotation's coming and technology is going to take over and be the leader and all of these things, and you still believe that story, then what you're doing is you're buying these charts. And I think what you're also doing is you're also buying bonds is what you're doing. So if you think that those high growth stocks are going to start doing well again, I don't anything more than a mean reversion. I'm not seeing any sustained outperformance in the horizon for sure. I think you're also buying bonds because if you think that growth areas are going to outperform, you also think interest rates are going to drop. So you're buying bonds essentially. I don't want to buy bonds, and I don't want to buy these charts, and I want to stick with what's already working. I think is really the idea. So here we're looking at small caps. The way I learned it is that former support turns into resistance, right? We call that polarity. And is former support going to turn into resistance? So far it has. I think that's really a key area to watch, and this is really it. Here you're looking at your small cap value, holding on to that support versus the Russell 2000, which is being dragged by those growth areas, which is already below all of that former support. So who's right here? Is it growth, and we're just retesting those former lows, and now we roll over, and then the value also breaks down, or does value have it right, showing the relative strength? They never broke down, and that's what we want to stick with, right? So that's really the question here. So in terms of the small caps. So let's get into what's already working. Like you can get cute and be like, oh, maybe, this Lemonade or the Rivian or one of these ARC names, maybe it's time to buy those. Yeah, maybe. But what you're betting is that you're the first one in, and now everybody's going to agree with you in your infinite wisdom. That's what you're doing by bottom fishing. The way I learned it is that bottom fishing can be very hazardous to your wealth. And what you're doing is you're getting cute. You want to be the first one in, and then you're betting that everybody else is going to agree with you and follow along. Or you can continue, as we've been doing, continue to take advantage of where the relative strength is, the things that people are already buying, the things that have been working. And, if the XOP, we're waiting to see if it could stick this landing. But if we're above those fourth quarter highs in the oil and gas, these are the names that we need to own, the explorers and producers. And we're certainly seeing outperformance out of the oil services as well. The oil services have been laggards for a long, long time until recently. As the explorers and the producers really showing the relative strength. Now it's the oil services. Look at Halliburton, new 52-week highs. This thing just absolutely continues to rip. Look at Diamondback Energy. This is the FANG. So this is the good FANG. You've got the bad FANG, and you got the good FANG. The good FANG is the Diamondback Energy. This is the good FANG here, right? Then you got the bad FANG, which is the stuff they talk about on basic cable. When you compare the FANG, F-A-N-G, the actual company, FANG, versus the acronym, it goes from the lower left to the upper right. So if you've been buying the wrong FANG, the one that they talk about on TV all the time, like, what is it, Facebook, Amazon, Netflix, Google, like Facebook is destroyed, right? Amazon hasn't done anything in years. Just Netflix murdered, so these things are just kind of crushed. So if you've been buying those names, you've been buying the wrong FANG. The right FANG is F-A-N-G. This is Diamondback Energy. And here it is. When you overlay the crude oil breaking out above those 2018 highs already, is crude oil foreshadowing a breakout in the FANG. I think that's exactly what's happening. And if we are above 135 in FANG, which we're right there, I want to be a buyer of that breakout. Below 135, it's a little hairy. Above 135, I like it long. I think we can see 200. Why not? And you're taking advantage of this trend as opposed to buying that other garbage FANG that hasn't been making anybody any money. And this gets back to the overall trend of growth versus value. This is dirty energy versus clean energy. And the bet we've been wanting to make for a while now is we want to buy the energy companies and the companies that are the dirtiest and hurt the globe the most. Those are the names that we want to be buying. The clean energy ones are the ones we want to be shorting, the ones we want to stay away from. And, again, getting back to we want to be selling frowny faces and buying Smiley faces. That's what we see here, right? You got your dirty energy really outperforming that clean energy. We continue to think that, we're still in the early stages of that commodity super cycle, and I think it goes on for quite some time. So, we want to be buyers of weakness in these sort of themes. All right, so what else tends to do well in a rising rate environment? Financials. And within financials, we've definitely seen strength out of the insurance areas. Here, new 52-week highs. In insurance, this is IAK. Within insurance, you have reinsurance, so it's bigger than that. So just keep that in mind. Here's insurance on a relative basis. It looks like it's carving in a bottom. There's another smiley face. Those are the ones we want to be buying. Here's MetLife, $60 billion insurance stock. I used to spend a lot of time in the MetLife building back in my New York City days. And listen, if we're anywhere above these former highs, call it $68. Those are the former highs from January. Even the former highs from the fourth quarter. If we're above those levels, 65, 68, pick your poison of where you want to manage risk, but something like that. And we want to be buyers of strength here in MetLife. Look at Prudential, PFG. So PFG is a $20 billion. A lot of you are familiar if you watch commercials. 75, that's a good level. If we're above 75, 76, we want to be long. Below that, again, if we're below those 2018 highs, probably want to leave it alone. It's a little hairy below that level. And then when it comes to understanding what's in the United States, there's a reason the United States is the worst performing stock market in the Western Hemisphere. It's because of all that exposure to growth. If you own the S&P 500, 2% of your portfolio is in energy. 2% of your portfolio is in basic materials. If you own the NASDAQ 100, 0.0% of your portfolio is in energy. If you own the NASDAQ 100, 0.0% of your portfolio is in basic materials. 0.0% of your portfolio is in financials. So the best performing stocks in a rising rate environment, you get none of them if you own the NASDAQ. Because the NASDAQ is literally, by definition, the NASDAQ 100. It's the largest 100 companies out that are ex-financials. They literally, in the definition of the NASDAQ, they X out financials. And then when you look at energy and materials, 0.00. Like not even like a little bit of energy, 0.00. When you look around overseas, you're going to get a lot more exposure to natural resources. You're going to get a lot more exposure to financials. So that's why I think that these are the two most important charts in the world. You're looking at the All-Country World Index ex-US, and you're looking at the Developed Markets ex North America, so in the EFA. And if we're above those 2018 highs, there's nothing to be bearish about. This is a successful retest. I think the problems begin, and this whole thesis of the U.S. underperformance is due to growth, but there's a lot of opportunity elsewhere around the world, which so far there has been this year, plenty of it. I think that for that story to remain true, these two charts have to stay above their 2018 highs. And then notice the difference between emerging markets ex-China and emerging markets including China. Ex-China, it looks exactly like these other two, retesting those 2018 highs, right? So there's EMXC retesting those 2018 highs. And then look at EEM, which has a ton of China, like 37%, 38% China. Check my math, something like that. It's a lot. Certainly the underperformer there. Look at Europe, above the 2018 highs. Again, same thing. If we're below that, that's a problem as long as we're above those 2018 highs. In all of those areas, Europe, a lot more industrials than the United States, for example. Look at Japan. Was that a retest of those former highs? If that's the case, I think we can continue to make this bullish argument. Things are hairy below that, same as Europe, right? Same as all these other ones, right? Below the 2018 highs, things get hairy. We probably have to reevaluate everything. And then these are the performance through the end of the week of all the different country ETFs around the world. Look at Brazil leading the way up 15% this year. Peru, Chile as well, South Africa, Qatar, Saudi Arabia with their energy exposure, all of those things. And notice how the United States is nowhere to be found because the areas that have more are more oriented. The weightings are more value oriented. They continue to outperform, and I don't see that trend changing. Could it change today? Yeah, it could. It could change right now, right when I get done with this video. Sure, but we haven't seen any evidence of any changes in trend yet. Right? So let's be aware of that. With Brazil, Petroleo, Brazil. Petroleo meaning oil, and Brasileiro meaning Brazil. So you're getting the best performing country and the best performing commodity, asset class all in one name, you know. Like when semis are doing well and Taiwan's doing well, you buy TSM, right? Taiwan and semiconductors, right? This is kind of like that. Brazil's doing great. Oil's doing great. You buy Brazilian oil, right? So like, you know, at a certain point, there's a little bit of logic involved as well. This one presented a nice risk versus reward. We wanted to buy a breakout above 1260. We did. We're almost halfway to our target, up near 18 on that. And then notice the ADR index. Beautiful, beautiful consolidation. Once again, reflecting that support at those 2018 highs. In this case, it goes back much further than that, but all that former resistance turning into support. This is the ADR index. So these are all of the stocks, foreign equities, stocks that trade from other countries that have American depository receipts in the United States. Things like Petrobras, right, for example, or Vale, or, you know, we talked about Taiwan Semi, right? These are stocks that are outside of the United States. So let's take a look at our small caps. So this is the minor leaguers report. So these are stocks between $1 and $4 billion in market capitalization. We're looking for strength. You know, a lot of small caps have gotten killed, particularly on the growth side, on the more value-oriented sectors. A lot more strength. Notice how we are sorting by strength here. Oil and gas midstream, explorers and producers, more equipment and services for oil and gas drillers. Here's a regional bank. You got your chemicals, more oil and gas. I mean, just, you know, coal, oil and gas midstream, more oil and gas equipment. You know, these are more regional banks, more oil and gas. There's a theme here. So when we're doing our global macro analysis, and we're doing our sector work, and we're looking for individual stocks, great. And then when we run these scans, now we're getting the same information. Like, hello, these are the stocks that are showing up on the scans. These are the stocks that are showing up in common sense and just intermarket logic, right? So just a few names here standing out of the small caps. Here's a $1.8 billion oil and gas equipment and services. 750 is the level there. This is next tier oil fields, NEX. I like the new highs in relative strength. And if we're above 750, I like it long, target of 1250. If we're below 750, leave it alone. And then here's High Peak Energy, HPK, beautiful base, $2 billion explorer and producer. And if we're above 19.5, I like it long. HPK, if we're below 19.5, leave it alone. Above that, I like it long, target up near 28. And the S&P 500 has just been a mess. People are like, oh, JC, are we going to go into a bear market? Are we going to go into a bear market? 70% of the NASDAQ has fallen by 20%. 70% of stocks in the NASDAQ are down over 20% off their highs. Almost half the stocks on the NASDAQ have been cut in half. I'll say that again. Over 70% of stocks that trade on the NASDAQ have lost over 20% of their value in the last year. Almost half the stocks on the NASDAQ, their prices have been cut in half. And I'm getting asked if the United States is going to enter into a bear market in stocks. If you think that that's a bull market, I said it yesterday, I think you need to check yourself into a mental hospital. Those are not bull markets. Half the stocks have been cut in half. That is not a bull market. The average drawdown in the NASDAQ right now is like 44% or 45% or something ridiculous. Is that really a bull market in your world? What world do you live in? Anyway, that's my rant. I like this base and emerge. This is like an alternative. It's not the most liquid, but it's not super liquid either. This is a high-yielding ETF for emerging markets, DEM. And it looks way better than EEM. Looks much stronger. And again, it's less about the yield that you're getting. I think it's only like 1.4, 1.6% or something like that. And more so the exposure that this particular index has. Look at that 22.4% materials. EEM's got nowhere near that. And much less technology than other areas like United States, for example. By the way, if you're interested in these slides, email me, info@allstarcharts.com. I'll send you slides. Make sure to use the password rotation, 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 because if you don't use the password, you're going to get some random presentation that I gave about in Kuala Lumpur about palm oil futures or something like that. Info@allstarcharts.com, password rotation, rotation, rotation. Make sure to use the password, and I will send you this deck, or Peter will. Anyway, so how about copper? Right, we're talking about all this, materials and strength and things outside of growth. And I think copper's in that category, guys. Looks like a nice healthy base to me. And then here we're looking at the Bollinger Bands. So basically measuring, the width of the moves, the volatility, we're just seeing nothing, right? So from compression comes expansion in volatility, right? Volatility is mean reverting, both directions, as opposed to price, which price trends. Volatility mean reverts. You want to know a nice little life hack? A lot of traders, even though they know that prices trend and volatility mean reverts, in practice, a lot of traders try to play mean reversions more than they do trend following systems, right? And when you learn technical analysis, like all the books are always like teaching you about mean reversions and all these reversal patterns and all that stuff. When the truth is, the reason technical analysis works is that markets trend. We know that for a fact. So if there's something moving higher, there's a higher likelihood it's going to continue to move higher, and vice versa if something's moving lower. It's volatility that is the mean reverting vehicle, right? So remember that. Life hack. Prices trend, prices of assets, and volatility mean reverts. So we're looking at the ratio between copper and gold. That's really the deal here, because historically the ratio of copper to gold trades with the U.S. 10-year yield. So if the U.S. 10-year yield is already breaking out, regional banks, and you're seeing that rotation in the stock market, energy, doing well with higher interest rates, what are we waiting for? We're waiting for the copper-gold ratio. When's that going to get going, right? Gold futures are doing what it needs to do for the copper-gold ratio, which is nothing. Gold just continues to just do nothing, just collect dust. Just does just nothing for anybody. Longs aren't making money. Shorts aren't making money. Selling volatility. We have put in a couple of short vol trades in some of these, like selling downside puts, put spreads as well. That's worked more often than it has not, even in the gold market. So a lot of people they think that you're like, oh, is it going to go higher or lower, JC? Is it a buy or a sell? Well, what if it's neither one of those? What if it's probably going to continue to trade sideways, and we get profit from that too? People forget that there's also that, and you don't necessarily have to be bullish. You could be not bearish, right? So like in gold, for example, I'm not necessarily bearish, but I'm not really so bullish either. So you can just sell downside premium. We haven't this week, because Sean thinks it's a little stretched, but it's not the point. Just generally speaking, taking advantage of non-trending markets and collecting that income and taking advantage of traders that are getting chopped up is great. I talk to a ton of traders every day. That's what I do. I talk to traders. I've heard so many times, JC is the worst quarter I ever had. This is the hardest market I've ever had to trade. I hear that a lot. And they're getting chopped up, a lot of these traders. So if you're on the other, remember, there's somebody on the other side of that trade that's collecting all that income from traders getting chopped up. And I want that to be us as much as possible in those particular types of environments, and this is one of them. Look at this breakout. This is chemicals, Chilean chemicals. Big, beautiful base. If we start taking out those highs from the last decade, this is one we want to own. This is SQM, Sociedad Química y Minera de Chile. And then here's the agribusiness. So again, sticking with that theme of materials, chemicals, this is the agribusiness ETF, MU. If we're above 85, I like it long, target up near 140. And then here's the agriculture ETF. So this is the commodities. So these are the companies in the agriculture business. These are the commodities of agriculture, just absolutely ripping. So the two different situations here, but telling you a similar story. Look at John Deere. I like this above 400. I like Deere long with a target up near 580. This is a $122 billion company. Heavy construction and machinery. A lot of you are probably familiar with it. I know nothing about heavy construction and machinery, and even I know John Deere. This one coming from our Hall of Famers report, which we put out on Fridays. This one is, we look at the largest companies in America, largest 150 stocks in America by market cap. And John Deere, definitely part of that category. Look at metals and mining. Look at beautiful base. Look at those 2018 highs. Doesn't this look like a lot of those other charts that I showed you before, right? Like the international ones. Here, let me just go back real quick. Like these, you see 2018 highs, 2018 highs. These are the international ex-US stocks. And then here we are. Same thing, right? 2018 highs, and here we are, right? Doesn't look exactly like that. Momentum never got oversold. That's bull market characteristic. It'll break out above 48. We want to be long. Target up near 55. But take that one step further and look at the components inside of XME. What's driving this index? I encourage you to check that out. Look at the steel ETF. Very similar. Look at the 2018 highs. Breakout, retest. As long as we're above 52, I like the steel index long. Target up near 73. Just look at these types of names. Arch Coal, breaking out of bases, 2018 highs. Alcoa, there's aluminum. Aluminum has been ripping. breaking out above the 2018 highs. A lot of these charts look very similar. International stocks look like these. Look at tech resources. Here you're getting copper, coal, zinc energy, breaking out above the 2018 highs, right? I think that really tells the story. So in agriculture, corn making new highs, livestock making new highs, coffee making new highs. So you're seeing that theme across the board. And let me just finish up with just real quick. This is the short report. So we're looking for the weakest areas in the market. And as you can see here, the company's making new 12-month lows, things like that. Some of the worst areas are in growth. And let's take a look at, so here's the short report. So these are the worst names in America, or ADRs as well. These are the names that are terrible. So PayPal, obviously on that list. If we're below 121, we like it short. Target of 82. Anything above 121 can't be short. Look at Facebook. If we're below 222, we want to stay short. Target near 174. If we're above 222, you can't be short. So what I like about these two trades is that the risk is very well defined. Above 121 can't be short. Below that, I like it. 222, if we're above that, you can't be short. Below that, I like it. And then there's the opposite, right? So if we are able to get back above those levels, not only are they not shorts, maybe they're longs for a mean reversion. Things like Peloton, but we got to be above that 40 level. Below that, you can't touch it. Square against those former highs, maybe, above 100, but you're bottom fishing. But the point is, whether you're on the long side or the short side, the levels are well defined and it's pretty binary either way. This is our unusual option scan. These are, stocks showing big splashes, both bullish and bearish. Big splashes in the options market. Datadog came up on the latest scan. If we're above 175, I like D-Dog long. Below 175, leave it alone. Above 175, I like it long. Target of 264. A lot of options activity coming in the last couple of weeks. And then finally, here's the Inside Scoop report. So this, we scan all the SEC filings for Form 4s, 13Ds, all the congressional YOLOs, and Ralph Cruz loading up on some Bitcoin, buying some Bitcoin, this particular senator, popping up. If we're above 41, you can't be short Bitcoin. I think the risk is higher if we're above 41. Below that, it's hairy. Above 41, I think Bitcoin's probably fine. Here's the disclosure from Ted Cruz buying some Bitcoin. So if you're interested in the slides, please email me, info@allstarcharts.com. I'll send you all those scans, send you all the slides. Make sure to use the password, rotation. And as always, I'm JC Parets. To quote the great philosopher, Mr. Jay-Z, you could be anywhere in the world, but you're here with me, and I appreciate that. Adios.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.